Okay, guys, we've spoken enough about what is a group of companies, when is a group of companies formed, and we have established that everything is about control. And if you can remember correctly, and you better remember correctly, we have the IFRS interpretation of control, and we have the Company Act definition of control, and you must be able, in order to talk about both of those viewpoints, exactly what is control under each of them, and then obviously you must be able to apply that in a question. Now, we've said once we have a group of companies, and we have established what is a group of companies, we have to prepare consolidated financial statements. Now, how do we do consolidated financial statements? Now, don't think you can skip the following YouTube videos. Don't think you're going to take a shortcut and you're not going to look at this, because then you're never going to understand what we try to do. So the first one is very important. Go and have a look at that video. Then you have another example, and this is not very long videos, so please do yourself a favor and go and watch these videos. You go and have a look at that video. And then the last one is you go and watch this video, which is about the so-called complex group, and another name for a complex group is a vertical group. So if I have PSSS, then you have a vertical group, and that is what they classify as a complex group. Now, IFRS 3 is all about business combinations. Now, IFRS 3 identifies several types of business combinations. It says whenever there's a group of companies, control is exercised by one company over another company or companies. It says, and once you have established that, you have to do consolidated financial statements. That is what we call group statements. It says, but then I get a different kind of business combination. That is, a company does not control another company, although it has a significant shareholding in that company, has between 20 and 50% shares in that company, but it does not completely control that entity. Now, in a case like that, that entity in whom he has the shares or the shareholding is classified as an associated company. And for associated companies, we do equity accounting. Now, we don't do equity accounting this year. I think you only start doing that next year or the year thereafter, I don't know. But equity accounting is close. It's got some similarities with consolidated financial statements, and then it is completely different as well. But that is only for associated companies. Then the third type of business combination that you get is joint ventures and joint operations. Now, there's a separate IFRS statement for that as well, and that is where two or more companies work together. They have a common goal that they want to achieve. They work together, each one of them contributes something to this agreement, and then there are rules and regulations how the financial statements of this joint venture or joint operation should be compiled at the end of the day. Now, that you don't do this year either. I think you also do that only in your third year. So the one that we're busy with is really group statements, consolidated statements. And he says, number one, how do I go about in order to determine what is the consolidation? Must I consolidate or must I not consolidate? How must I go about in this whole process? He says, number one, you have to identify the business combination. So what type of business combination do we have? Do we have a group, do we have an associated company, or do we have a joint venture or operation? Now, for that, we have an acquirer and the acquisition date. Who is acquiring the shares? Who has gained the control? And at what date did it happen? And then you can identify the type of business combination. Once you've done that, you're going to measure the value of the identifiable assets and liabilities. And if it's a group of companies and you do not acquire 100% interest in this investee, this company that you've invested in, then you have to determine how much of that company in whom you have invested in belongs to outsiders. So what is the non-controlling interest? We've spoken about this term non-controlling interest in the previous videos. So if you still don't know what it is, go back and check. So if I have bought 80% of the shares in S, somebody else is holding 20%, and that somebody else we call the non-controlling interest. Now, if I have paid more for the share investment in this company that I've invested in than what the net asset value of that company is. What is net asset value, guys? Assets less liabilities. And what is assets less liabilities? Equity. So if the equity of a subsidiary company is 100 and I paid 150 for 100% shareholding in that subsidiary company, what is the excess over the net asset value? 50,000. So that excess, that equals then the goodwill that I've gained, that I've acquired. Now, let me explain to you goodwill. I always use MVG as an example to explain goodwill to the students. I'm speaking about a normal year, not 2020. In a normal year, everything is pumping and going at MVG. MVG is around about 5 years now old. Now, I don't know who the owners are, so I haven't got a clue. But I can think when they started up, what did they buy? They bought and actually set up a bar facility. They have their music, their loudspeakers, that kind of things. That is the type of assets that they have purchased. So what would have been reflected if they started from scratch on the balance sheet? What would they have said? They said, well, non-current assets will be all these fixed assets that they have. The bar counter, the cupboards, the coolers, the fridges, all those kind of things. That would have been part of their non-current assets. And probably they have a little bit of current assets, and most probably they have a little bit of current liabilities. But now, everything started off with a bang, and the students love the place. And the students meet there every night, or every second night, every Friday, every Saturday night, and they really enjoy partying at MVG. So now the owners of MVG wants to sell the place. So what is in the statement of financial position? Only this non-current assets less the depreciation that they've written off over 5 years, which is probably most of the value of the assets. So what is the net asset values on paper? Well, I can't think it is millions of rands. But what is very important is the underlying value attached to MVG. What is that? The fact that the students love to hang out there. The fact that the students love to spend their money there. The fact that the students return over and over again and party there. And is there a value on the balance sheet for that specific thing? No, there isn't. Where does MVG make their money out of? Out of the bar counter that's standing there? No, they've recovered that money a long time ago. Where do they make their money from now? From the returning clientele that they have, the returning students coming there and spend their parents' hard-earned money there in the club. That is where they get their money from. And that is what makes them profitable. So when MVG decide to go and sell the MVG business, are they going to sell that business at the net asset value as reflected on the statement of financial position? No, guys, for sure not. They're going to add to that an intrinsic value, an underlying value. And the guy in one of these videos called it very nicely. He says, think of goodwill as reputation. They're going to sell the reputation. They are going to say, this is a nice place. It's a lekker place. This is where we really get together and we hang out. So they're going to add a value. They're going to attach a value which represents that nice pumping feeling to the underlying asset value of the company. And then they're going to say, well, the net asset value is, argument's sake, 500,000, but this value attached to the business, that is at least another 300,000 worth. So if you want to buy this business, you have to pay for it 800,000 rand. So now I come in and I says, well, I'm going to continue making a lot of money here. So I am prepared to pay 800,000 rand for a business, which on paper is only worth 500,000. Assets less liabilities equals 500,000. So this excess of 300,000 that I'm prepared to pay for the business, that is what we call goodwill. Now it's 2020 and we talk about the lockdown period, that first couple of horrendous months where we were not allowed to go anywhere. And places like MVG was closed altogether. They were not allowed to operate. And let's assume in this lockdown period that the owners of MVG said, well, we cannot bear the costs anymore without earning 1 single cent of income. Before we're going to make too much losses that we will never recover in our lives, let's sell the business before we are very, very deep in debt. And on paper, the net asset value was 500,000, but they were prepared to accept 400,000 for this business just to get out of there because they cannot afford, or they could not afford to carry on any longer. I walk in, I have a bit of spare capital, and I can stick it out because I know I'm going to buy a bargain here. And I know once the doors is going to open again and everything is back to normal, MVG is going to pump again and I'm going to get all my money back and more. And I have the cash to carry myself through a period that I'm probably not going to operate at full capacity. So I buy the business for 400,000 Rand. On paper, the business is worth 500,000. So I purchase the business at a discount of 100,000 Rand. Now that discount is what we call a gain on a bargain purchase. Now goodwill, where I pay more than the net asset value, that is an intangible asset and will appear as part of non-current assets in the consolidated statement of financial position. A gain on the bargain purchase is where I bought that asset for an amount which is less than the underlying net asset value of this entity. And that I'm going to recognize in the consolidated income statement. So that is the difference between goodwill and a gain on a bargain purchase. Now, business combination, that is a transaction or event in which an acquirer obtains control of one or more businesses by the transfer of cash, the incurrence of liabilities, the issue of equity instruments, or by contract. That is how a business combination actually comes to light. A business, you all know what a business is. It's an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return, making profit, in the form of dividends, lower cost, or other economic benefits. Now, IFRS 3 prescribes 4 steps when we're going to do consolidated financial statements. It says, number 1, identify the acquirer. Who is buying the assets? Who is investing, in other words? The second thing, which is extremely important, is what was the acquisition date of this acquisition? When did we make the investment? Then we have to go and measure the value of the identifiable assets and the liabilities attached to this entity in whom we have invested in. Why? To determine whether we've actually got it at a bargain, which is going to be a bargain on the purchase price, or is it going to be goodwill that we have acquired when we bought this investment at a certain price. And then if I bought the 100% of that business, that's fine. There are no outside parties. So that means I will stop there. I'm only going to measure and identify and my assets and liabilities. I'm going to see how much have I paid, and I'm going to determine whatever the amount is that was the goodwill or the bargain on the bargain purchase, the gain on the bargain purchase. But once I only acquired a portion of the business, so I've only acquired 80% of the business, then I must know that I did not buy the whole business. I must also, after I have determined what was the underlying value of the assets and liabilities of this business, I must give the non-controlling interest their portion of that value. I didn't buy their portion as well. I only bought 80%. So once I've placed the value on the total business, I must say 20% minus 20%. That is the NCI's business, or their portion of that business, 80% of that value. That is what I have acquired. And that I will then compare with the amount that I've paid for this investment. So that will then determine what is the goodwill or the gain from bargain purchase, which I have to identify and recognize in my statements. So number one, they said we have to identify the acquirer. Now who's that? That is the party that's going to gain control over another party. Who's making the investment is going to get control. The second step is determine the acquisition date. Now that is the date on which control was obtained. Let's see, P Limited acquired and paid for 70% of the shares in S Limited on 31 October 2018. P Limited agreed with the former owners of S Limited to take control over S Limited's business on 30 September, that must be 30 September 2018. As from 30 September then, P Limited will control all the assets of S Limited and they will assume responsibility for all the obligations of S Limited. So on what date was control obtained? At the date that I specified in the contract, which was 30 September. So the acquisition date of this investment was then 30 September, although the finalization date of the transaction was only the 31st of October. Now consolidation. When we're going to start consolidation, we have to determine the date at which the investor gains control over the investee, and it will stop at the date when control is lost over the investee. Now, in certain cases, when the requirements are met, consolidated financial statements are not required by the parent company. We said, well, as soon as we have established that there's a group of companies, we have to prepare consolidated financial statements. He says, but there are a few exceptions on the rule. He says, circumstances when the parent does not have to prepare consolidated statements is where it is a wholly owned subsidiary or where it is a partially owned subsidiary and all the owners have voted that consolidated statements are not required. So let's have this group structure. P, who holds 60% of S, and S, who holds 70% of SS. Clearly, it's a group, so P actually has to provide consolidated financial statements, but SS is also a subsidiary of S Limited. So the question is, must S Limited now prepare consolidated financial statements? And the answer is no, because the holding company of the group, P Limited, is going to prepare consolidated financial statements. However, S Limited must tell this 40% shareholders, non-controlling interest, that they're not going to prepare consolidated financial statements, and the reason for that is that they are part of the P group of companies. So the owners must, that they have voted and they've given their approval that there is no consolidated financial statements. The second requirement is that S in its own right must not trade on a stock exchange. Once they adopted equity instruments of S must not be traded in the public market, so in the stock exchange. If that was the case, they had to prepare consolidated statements as well. It did not file its financial statements with the Security Commission or any other regulatory organization to issue any class of instrument in a public market. So the golden rule here is once you're going to enter into any transactions on the stock exchange, in the public market, you have to provide consolidated financial statements. You cannot get out of it. Its ultimate or intermediary parent produces consolidated financial statements that are available for public use. Now, I don't know whether you can remember, but in the previous videos, I gave you the group structure of Naspers. And I said Naspers Limited is being held by primarily 53% by Kermstraat and Naspers Beleggers. And I hold for 53% of the shares in Naspers Limited. Who is trading on the JSE or on any stock exchange? All2X, JSE, Naspers Limited. Not Kerumstraat, not Naspers Beleggers. So Naspers is, Naspers Limited is. So therefore, there's nothing in Kerumstraat except its investment in Naspers Limited. There's nothing in Naspers Beleggers except its investment in Naspers Limited. Naspers Limited, that is actually where the whole group comes together, and that is actually, although they're not the ultimate holding company, they are the holding company where everything takes place. They are the company who is trading on the public market. So Kerumstraat is not going to do consolidated financial statements because it doesn't make sense. But Naspers Limited, also not Naspers Beleggers, is also not going to do consolidated financial statements. But Naspers Limited, they will have to do consolidated financial statements because they trade in the public domain, so they won't be able to get out of there. Now, when we're going to do consolidations, it is important that the parent company and all its subsidiaries must have the same financial reporting date. So if the financial year end is 30 June, everybody must have a 30 June financial year end. If there is a good reason why one of the subsidiaries doesn't have a 30 June financial year end, the fact must be mentioned and the reason for that must be mentioned. And then over and above that, it must be an extremely good reason why that date of them differs from the 30 June financial year end. Also, the whole group must have the same uniform accounting policies. Guys, we're going to add all the assets of the group together. We're going to add all the liabilities of the group together. Now, if those assets and liabilities were not determined in the same way, what are we going to do? We're going to add figures together that doesn't make sense at all. And there's no way that the reader of the financial statements will be able to make sense out of that. So we might as well leave it. So that is the reason why it is absolutely important, you cannot get out of there, that all of this, the whole group must apply exactly the same accounting policies in order for the figures that you're going to add together to make sense. What is the procedures when we're going to consolidate? Now, the first thing is that we have to eliminate common items. Now, what is an example of that? Guys, let's say that we have acquired 100%. I'm P. P have acquired 100% of S. P, of all the issued share capital of S, in other words. P had bought that for 100,000 Rand. So there will be a cost investment in P's statement of financial position. Investment in S Limited equals 100,000 Rand. In S Limited's set of financial statements under equity, you will have issued share capital, 100,000 Rand. Who are holding that share capital? P does. So therefore, that 100,000 Rand investment must be taken out of P Limited's books, and the 100,000 Rand equity lying in S Limited must also be eliminated because it's a common item. The one is the shares that they're keeping in S, the other one is the shares that they issued to P. Can you see it's the same shares that we're talking about? So common items must be eliminated. Non-common items must be consolidated. Now, again, if we talk about equity, we cannot just simply add P Limited's equity to that of S Limited because S Limited's equity equals the shares that they've issued, of which P Limited are the holder of. So the equity figure, the share capital figure, will always be only that of the holding company, of the parent company. The retained earnings and reserves figure will only be that of the holding company plus the reserves and retained earnings of the subsidiary which was earned after the acquisition date. P Limited doesn't have any say over the pre-acquisition retained earnings and reserves of this entity. Now, the way that we're going to eliminate common items and things like equity and pre-acquisition reserves and earnings is by ways of a pro forma journal. Now, a pro forma journal has a debit and a credit, but it is not being posted in either the holding company or the subsidiary company's financial records at all. It is something that you do on a piece of paper. There is a debit and a credit, yes, but the one leg of the transaction can lie in the holding company's books. The other leg of the transaction will lie in the subsidiary account of a subsidiary company's books. So therefore, if you're only going to look at the holding company isolation, there's a one-legged entry going through there, and there's a one-legged entry going through the subsidiary. But in totality, I have a debit and a credit. So pro forma journals is journals that we do especially for consolidation purposes, and it happens on a piece of paper. Now they talk about a worksheet. Now usually how you're going to go about is you're going to have the holding company's statement and financial statements here. You're going to have the subsidiary company's financial statements here. Then you're going to have your pro forma columns, debit, credit, where you're going to eliminate common items and things like equity of the subsidiary. And then you're going to have your final set of consolidated financial statements, which will be all your assets added together of your holding company and your subsidiary company, except the intergroup assets, which you're going to eliminate in your pro forma journals. So what you're going to end up with eventually is only the consolidated financial statements, which is an aggregation of figures between the holding company and the subsidiary company after I've taken out certain pro forma common items. Okay, so that will give you my consolidated financial statements. So on consolidation, whenever one company, parent company, exercises control over another company, i.e. a subsidiary company, you're going to add 100% of the assets and 100% of the liabilities of the parent company with 100% of the assets and 100% of the liabilities of the subsidiary company. It does not matter whether I only have a 70% interest in the subsidiary company. I'm still going to add 100% of the assets and 100% of the liabilities. Now, that portion, which does not belong to me, is going to be accounted for in the non-controlling interest item, which is going to be shown as part of the consolidated equity section of the company. The carrying amount of the parent's investment in the subsidiary and the parent's equity share of the subsidiary are offset against each other. And then if there's goodwill, I'm going to account for the goodwill in the consolidated financial statements as part of non-current assets in my books. Any intergroup balances and transactions between the parent and the subsidiary have to be eliminated by ways of the pro forma journals. So let's assume that P has borrowed 100,000 Rand to S. So in S's financial statements, they will have a liability, loan from P. In P Limited's set of financial statements, he's going to have an asset, loan to S. So it's the same loan. The one gave the loan, the one received the loan. So what is going to happen on consolidation? As part of my pro forma journals, I'm going to take out those loan balances in both the subsidiary books as well as in the holding company's books. So that's going to cancel each other out. So there will be in the consolidated financial statements no loans shown whatsoever. So there won't be an asset with a loan amount and there won't be a liability with a loan amount. So pro forma journals are used for the preparation of group statements. These journals are not recorded in any of the individual statements. It is only for consolidation purposes, so none of them are posted in either the subsidiary books or the holding company's books. So let's look at an example here. Let's assume that P has 100% interest in S. and P has bought that interest at 40,000 Rand. S has then equity, share capital of 40,000 Rand. So now I'm going to consolidate, and the group is going to show what? Assets and liabilities I'm going to add together, but I must eliminate common items. Good. So there's no common items under PPE. So my total group is going to have PPE of 150. I'm going to add 100, I'm going to add the 50, that's going to give me 150. Now, the investment in S is a common item, so I'm going to eliminate that 40,000. So I cannot show that in the group. So that would be a 0 in the group. Current assets, I'm going to add together. So my current assets is going to be shown at 30. Equity, I must remember I have to eliminate the common items. So I will always end up as the equity figure, only the figure associated with P. So there's the 40 that I'm going to take out. There's another 40 that I'm going to take out. So what am I going to show at the end of the day? Only the 100,000 equity of P. Now this is as at the date of acquisition, which those two will be the same. But obviously a year after this won't be the situation anymore, and the equity of S will not be equal to the total investment. Now what I do add with the equity figure of the holding company is all reserves and retained earnings that the subsidiary has made after the acquisition date. So if the equity after the acquisition date was 100 and it was 40,000 at the acquisition date, that difference of 60 would have been added with 100 and our group figure would have been 160. So at the date of acquisition, equity will only be that of the holding company. After the acquisition date and subsequent times, it will be the equity of the parent company plus the post-acquisition reserves and profits of the subsidiary company. And that is going to be total equity. And then the last one would be our total current liabilities. We're going to add the two together. That's going to be 80,000. So if I look at my consolidated statement of financial position, I'm going to have total assets of 180,000. If I look at my equity and liability side, I'm going to have total equity and liabilities of 180,000. So that is going to be in balance. This 40,000 and that 40,000, that was a pro forma journal. I credited the investment in S with 40,000. I debited the equity of S of 40,000 in S's books. That would have been in P's books. So you can see one entry lies in P's books, one entry lies in S's books. So I have to do it on a piece of paper. I cannot affect it in either one of the two's own financial records because I cannot pass one-legged entries. So therefore, upon a consolidation, what happened? That 40,000 fell away, that 40,000 fell away, nothing was retained there, and only the holding company's 100,000 was retained there. Non-controlling interest, please go watch these two videos first before we're going to proceed. We say, well, we ignore to a great extent fair value, because we only work on the share of net assets method. Now you'll see how we're going to go about, but you should know that what is important is that a group comes together when control is gained by one entity over another entity, and once control can be proved, it means that there's a group of companies and we have to provide consolidated financial statements. Just to recap our working methodology in doing consolidation. Number one, do an analysis of the owner's equity in the subsidiary company. Number two, pass all the pro forma consolidated journals to get rid of all the common transactions between the subsidiary and the holding company. And then number three, prepare a worksheet. Pro forma journals, we said, are prepared to eliminate the effect of internal transactions between the parent and the subsidiary. Pro forma journals are not recognized in the individual general ledgers of either entity, so not in the holding company's books, not in the subsidiary company's books. It's a piece of paper on your worksheet. And it may happen that the ledger account in the parent's trial balance is debited, like or credited. In the case of the investment company in the subsidiary, that account was credited, while a ledger account in the trial balance of the subsidiary is either debited or credited. Now there we have debited the share capital of the subsidiary company, but that only happens on the worksheet. Components of consolidated financial statements, guys, we have them all. We have a consolidated statement of financial position, of profit or loss and other comprehensive income, of changes in equity, of cash flow, and we have a consolidated notes. Goodwill, please go and watch these two videos so that I can explain further to you what goodwill is. And we said goodwill is the interest acquired at a value more than the fair value of the identifiable assets acquired and liabilities assumed. So that's an acquisition at a premium price with the NCI, non-controlling interest, based on the acquiree's identifiable net assets at the acquisition date. So the NCI is also based on what the actual value of the assets and liabilities were. Goodwill is an intangible asset that is presented as a non-current asset in the consolidated statement of financial position. A gain from a bargain purchase, please go and watch that video. And that is interest acquired at a value less than the fair value of the identifiable assets and the liabilities. So I purchased that interest at a discount or a bargain, and obviously the non-controlling interest will also be based on this value that I've established when I actually purchased the investment. A gain from a bargain purchase is recognized in profit or loss at the acquisition date. In the example, it was taken to retained earnings as there is no other income or expenses at this stage. We're going to do an example so you see what happens there. Non-controlling interest, when the parent does not acquire the entire issued share capital of a subsidiary, only buys, let's say 60%, the remaining 40%, that belongs to the non-controlling interest, NCI for short. Non-controlling interest must be presented separately in the consolidated statement of financial position, and we do that in the equity section. So make sure that you understand that. Now guys, that is all the background information of consolidations. It's now time that we're going to start some exercises, but you cannot do exercises, you cannot understand exercises if you do not have a solid base before we're going to start with that. And please remember that I will for sure ask a theory question on group statements as well.